Welcome to week 4. This is the module 1, and we're going to talk about the pros and cons of gifting. I would say that next to week 3, week 4 is the most difficult course. However, because of the laws of trust, we cover a lot more gifting, not only in the course or CF or estate planning, but also when you're taking the exam. Between gifting and trust, very heavily on the CFP exam. My concern is that gifting in general is an emotional decision, which means it changes. And I think too often people make gifts and later change their mind. And we're going to talk about some of those problems and when is the proper time for you to give guidance for people to gift, and when should you tell them not to gift. Many times the financial advisor has a very big impact in this area, and as a fiduciary, you have a responsibility to watch out for the client, which means, as a general rule, they should not be gifting, and we'll explain what are the decisions when they should gift. So this should be an interesting discussion. I see my two friends on the chart here having a little bit of debate, and I think that if we were in a classroom setting, this would be a perfect session to have some debating on, because we have different viewpoints. Gifts are, first of all, gifts are any transfers not made for fair market value. If I have something that I transfer and it's not transferred for fair market value, it is a gift. That surprises a lot of people, but that is the tax law. Gifts can be revocable, which means still controlled by the grantor, or irrevocable, transferred by or transferred to the trustee. And it's really a decision on the part of the donor, what they want. Revocable gifts are the most common by far, but because of this being basically a tax and financial planning class, most of the effort we spend in this class is on the irrevocable trust gifts, and that'll be probably 90% of our time is on irrevocable versus revocable. The main reason revocable even comes in is because it's the decision whether or not to gift. The reason I say that is a revocable gift is the same as retention by the owner. General rule is irrevocable gifting should only be made if there's a good reason, and we'll find there's only really four good reasons for gifting that you should advise. Advantage of gifting. First, it makes use of the gift tax exclusion, and there is some tax benefits, quite frankly, by gifting rather than keeping it in your state. It's definitely less costly than having a bequest, as we covered in Module 3, because the tax is on the gift as opposed to tax being on the bequest and the tax. It removes appreciation from an estate, and that's important if you're concerned about going from a non-taxable situation to a taxable situation. You'd like to get out of that. Taxable income moved to lower marginal income tax basis, and that makes sense. It also makes sense that you keep track of the marginal tax basis of what you give the individual you're giving the tax to. We have special elections that can be made, which we'll talk about, that can have tax benefits. There's no transfer tax until the annual exclusion and lifetime credits are used. And again, the annual exclusions are pretty straightforward. The lifetime credit is a judgment area, which how much of it and if any should be used, because again, what you use for purposes of gifting cannot be used for your estate tax. Greater privacy than probate, obviously, because probate's open to the general public. If we give a gift to somebody, we can watch them, see how they manage the assets to see if they should be getting more assets. By the way, that's a common answer on the CFP exam, the observation of the beneficiary and how they control assets. Vicarious enjoyment of seeing donees benefit. Well, I think parents, that's probably true. For kids, certainly we see that at Christmas time. Provide for donees education, support, and well-being, and that it's good motives. Give donee an incentive to run the family business by giving a gifting into the business. So these are listed some of the advantages of gifting from a what we call financial and as opposed to emotional basis. Disadvantage of irrevocable gifting, in other words, giving up the asset. Tax forms and payment have exceeded the exclusion of lifetime exemption, and this can be a lifetime monster for the rest of your life, having to fill out forms and pay, obviously, people to fill out the forms. You lose your stepped-up basis at death, and a good rule of thumb is if the item that you own has a low basis and a high fair market value, it's a terrible thing to gift because of the terrible tax consequences. It's much better to, quite honestly, keep in your estate. Possibly decline in future property values resulting in lower transfer tax. And unknown tax laws in the future may be more favorable. Who knows? Again, these last two items are judgmental, and you have to make a decision on a very gray area. Doesn't cover possible changes in circumstances. Again, subjective area. Loss of use and income of the property, and that has come up several times in my career where individuals have given away assets to reduce their estate, and then they came up on high medical bills, and the high medical bills ate up the rest of their assets. So that, again, we have to be careful when we think about whether or not we can afford to lose the assets. Irrevocability of the decision. Once you give it out, you can't get it back. Psychological loss due to lack of control. And we have a lot of control freaks in this world, and some people just don't want to give up control. In fact, people would rather pay taxes than give up control in many cases. Use of lifetime exemption reduces dollar for dollar the unified credit at death, and that becomes a decision that again has to be made after considering a lot of intangibles as well as math calculations and guessing at what the future will be. Factors to consider before making a gift irrevocable: the mental competency of potential donee to manage property. I'm sure you've all heard of people when they win the lottery, they spend all the money in the first month or two, or people who got an inheritance, it's very common, they spent the money in a month or two. That certainly should be taken into account before you're giving gifts to people as to how well they'll manage it when they receive it. And that was the concept we had in the previous chart of giving a gift to somebody to see how they would manage it, to see if they should be given more. The estate tax status of the potential donee. If someone was already in the $7 to $10 million bracket, quite honestly, they don't really need gifts because they're only going to add to their taxability. Where if someone is in this, say, asset range of $100,000 or $300,000, excellent decision to make a gift to them. The marginal tax bracket of potential donee versus your own, because if you're giving an item that generates income, you don't want to have it higher taxes within the family. Again, we're assuming these gifts are within families. And the degree of relationship that could be a tax advantage. And the best example I can think of that is the generation skipping tax. So these are additional factors to consider. Retention or control by donor, consequences of maintaining some type of control over gifted assets. And we have problems here. And first of all, the grantor trust rule may apply with tax consequences to grantor. If you didn't cover grantor trust rule in your income tax class, basically it's a rule that says that if the grantor retains any rights, they will be taxed on the item rather than the beneficiary for any income taxes due. Second, it may defeat some of the aspects of the estate plan, and some of these plans are very complicated, and just a slight transfer of what appears to be slight transfer today may be significant transfer something later on in the plan, and may impact that plan. May make assets subject to estate freeze rules covered later in the course. And although it sounds like that's bad, that's actually a good situation to be in. And could result in loss of future use of marital deductions in the estate, which is marital deductions our last module this week. Forms of transfer in the United States. Again, we're only talking about the United States. All countries, all cultures have different views. We have the outright gifting here, where I give you the asset physically. I give you the car, I give you the house, I give you the jewelry. Custodial, which is a Uniform Gift to Minors Act and Uniform Transfer to Minors Act. And then finally, gifts and trust, which are becoming more and more popular, and certainly from an estate planning standpoint, they are very, very important because it makes a lot more sense in most cases make gifts and trusts than either the outright or custodial. Outright gifts, it's the most common type of gift, but it has consequences. First of all, the donor loses control of the asset. The donor may be subject to gift tax, again, depending on the value of it. And if it's subject to gift tax, it'll be added to the donor's tax return as an adjustable taxable gift. And therefore, you're going to have to now have a gift tax return filled out in addition to your income tax return. Donor gets lower of donor's adjusted basis or fair market value at date of gift. And that's the real problem to me, is there's a difference between the basis of the donor and the fair market value at date of gift. The donee, the recipient, gets the donor's adjusted basis, the lower value, and that could be considerably lower. Or if the fair market value is lower than the adjusted basis donor, they get the lower of that value. So let's say I had some stock, I paid $100,000 for it, it's worth $30,000 today. I give it to my son, his basis is $30,000. Donee pays future income tax, and it could increase the size of the gross estate, and we have to worry about getting it. Somehow we got back to the wrong chart. Transfer of business property via lease back. Donor transfers business property to donee, but leases it back for business purposes. An example is I have a farm, and I have a tractor on it, and I transfer that tractor to my son, and he leases it back to me. What does that happen? Well, the business gets an income tax deduction for the lease payments, so now I get a deduction for payments I'm making on the lease. I will be subject to a gift tax because I gifted it. The gifted property will be removed from my estate. It goes to my son's estate. And the donor assumes donor's basis or fair market value gift, whatever is lower, and must report the lease payments as ordinary income. So the basis is probably going to be low because generally I would transfer it to my son because I could no longer depreciate it, which means that my basis is very low, and he's going to receive it at the low basis, so he's not going to really be able to depreciate it, and he's going to have lease payments as ordinary income. Now, you have to crunch the numbers in one of these to see if it makes sense. I've had CPA classes where it was very difficult for them to justify use of this method, and you say, well, why are you mentioning it, Lee? Because it's on the CFP exam a lot, and I would say this is an example of a theoretical as opposed to practical solution. But again, there might be a case in your client's unique situation where this might be applicable. Custodial gifts. The Uniform Gift to Minor Act allows corpus to include insurance, cash, and securities. A Uniform Gift to Minor Act has been around for a while, and it's designed for minors. Minor is determined by state law, and the unfortunate thing is you can only have insurance, cash, and securities in it. There's another law which is more common in the country. The Uniform Transfer to Minor Act allows corpus to include any assets. I think almost all the states today have the Uniform Transfer to Minor Act because of the flexibility of having more variety of assets under it. Now, where do you see these? Well, there's a baptism. There might be a bar mitzvah. There could be a confirmation. It could be the child graduates kindergarten, and people give gifts. And that could be relatives and neighbors, and in some cultures you have a big party for these, and people are expected to put cash in there. Well, that goes into this Uniform Transfer to Minor Act, or Uniform Gift to Minor Act, depending on what state you're in. And typically those go into a bank account under a minor account, and the custodian is either the parent or maybe a grandparent, and the custodian's job is to protect these assets. The custodian is not a fiduciary, and unfortunately, to give you my candid opinion, I call the Uniform Gift to Minors Act Dad's Beer Fund or Mom's Lottery Fund, because a lot of the time the money doesn't ever get very far in the children's bank account, withdrawn as needed, I guess, by the parents. The logic the parents can use, of course, is that they're using it for the health, education, maintenance, support of the child, therefore it's valid to take out. I don't think that was the intent of the donors, however, putting the money in there. So it is typically a bank account transaction, although it could be anything. It could be insurance, like mentioned here, securities, real estate, whatever. The thing that's unique about it you should be aware of, and it's been on the CFP exam before, is that if you're the custodian and you die, the value of the assets go into your estate, even though the assets remain with the child. So the child will still have the assets available for them, but you will be taxed for it if you die as custodian. Imputed interest on gifts. Not sure how many of you have had counting, but imputed is we're going to treat it as if type of situation. So we pay interest that is less than the applicable federal rate to a related party results in imputed interest. The donee doesn't get a tax deduction for imputed interest because they didn't really pay it, and the donor is taxed if it received income. Now, this is the idea of the government, is that if you do make a transfer to, say, an asset on a loan basis, like you're lending money to your son or your daughter to buy a house or to get married, or if they're older in the, say, 30s going to college, and you charge less than the applicable federal rate of interest rate, there will be imputed interest charged, and that means that even though you didn't charge the rate, you're going to be taxed as if you did. And that's where this here comes in. If it's unrelated parties and there's not interest charged, no problem. It's when it's a related party that we worry about imputed interest. That must be the end of this module 1. And if you have any time, I would suggest you go immediately to module 2, because this particular subject is all interrelated. Typically on these courses we have interrelated. Each modules try to be quite separate, but that is not true on this chapter. And we're going to see the same thing when we get into charities. We'll have later on in the course where we have multiple that tie into each other.